Hello, everyone. We'll start in just a moment. My apologies for any technical difficulties we had earlier. Hi, everyone. My name is Will Snodgrass. I am a certified financial planner, and today we're going to be covering Social Security. We're going to be talking about a number of different things pertaining to Social Security, such as when to file, when to wait, how your benefits calculated, how to maximize benefits, how benefits are taxed, and ways to minimize taxes, what spousal and survivor benefits really mean, and how to avoid costly mistakes that could reduce your income for life. So with that being said, let's jump right in. Um, so when previous generations retired, they probably didn't think too much about Social Security. They went down to the local office as soon as they turned 65 or maybe 62 if they retired early and applied for benefits. But things are different now, and people are approaching the Social Security question in a different way than they did previously. Most people tend to minimize the value of Social Security. If they understand that they are likely to get something back from the system at all, they think it will be a minimal amount, not really enough to count on, but Social Security is far more valuable than most people realize. First, Social Security is one of the few sources of income you can't outlive. If you're worried about running out of personal assets in your retirement, you need to not have that fear with Social Security because it continues until you die. And I know a lot of people have questions about the current state of Social Security. In our longer presentation, we actually have material we cover where we talk about how solvent it actually is. If you'd like that information, feel free to reach out to us and we'll be happy to provide it to you. But of course, with Social Security, the longer you live, the more you'll extract from the system. So let's go with an example here. If your benefit starts at $2,000 a month and you live 10 years, you'll receive $300,000 in lifetime benefits. If you live 20 more years, you'll receive $600,000 in lifetime benefits. And if you live 30 more years, you'll receive nearly $1 million over your lifetime. And this assumes an annual cost of living adjustment, or COLA, of 2%. Remember that acronym. We're going to be using it a number of times in this presentation. Second, Social Security offers annual inflation adjustments like I just was talking about. So if your benefit starts out at $2,000 a month and if your annual COLA is 2%, in 10 years you'll be receiving $2,438 a month. In 20 years, your benefit will be $2,972, and in 30 years, your check will be $3,623. There's no way of knowing exactly what future COLAs will be, but 2% seems to be a reasonable estimate. When your Social Security benefit's calculated, it'll be based on how much you earned over your working career and at the age at which you apply for benefits. So the formula for calculating Social Security is pretty complex. You may or may not want to follow along with this. Some people find the formula interesting, other people their eyes glaze over. So in a moment, I'm going to show you a couple ways to estimate your own benefit, but you don't have to. There's lots of great calculators available online, and we also have a number of wonderful ones as well. So the general process goes like this. First, Social Security looks at your annual earnings over your entire lifetime, indexes them for inflation, and picks the 35 highest years' earnings to include in the formula. The index earnings are totaled and divided by 35 to come up with an average. If you don't have 35 years of earnings, it's important to note the missing years will be filled in with zeros. Next, a formula is applied to your average indexed monthly earnings, or AIME, to determine your primary insurance amount, or PIA. And this is the amount you'll receive when you reach full retirement age. Each year, annual COLAs are applied to your benefit to help you keep up with the cost of living. And for those of us living in 2025, we can all attest to the fact that in the last few years, the cost of living has definitely gone up. So here's an example of how the benefit formula would work for a retiree who was born in 1963 and who earned the Social Security maximum every year since the age of 22. Their average indexed monthly earnings, or AIME, would work out to be $13,689. In calculating their PIA, primary insurance amount, the first $1,226 would be multiplied by 90%. The amount between $1,226 and $7,391, or $6,165, would be multiplied by 32%, and the amount over $7,391, or $6,298, will be multiplied by 15%. These amounts will be totaled to come up with a PIA of $4,020.90 per month. This is the amount the worker would receive at full retirement age. I told you it was complicated. Fortunately, you don't have to figure this out for yourself. So full retirement age is the age at which you can claim full unreduced benefits. It used to be 65 for everyone, but now we're seeing a higher full retirement age being phased in as a result of the 1983 amendments. For everyone born between 1943 and 1954, full retirement age is 66. For everyone born in 1960 and later, full retirement age is 67. And for those born between 1955 through 1959, full retirement age is 66 plus some number of months, depending on your year of birth. Now, remember that I said your primary insurance amount, or PIA, is the benefit you'll receive at full retirement age. So the question naturally is, what happens if you apply for Social Security before your full retirement age? Well, your benefit will be reduced. You'll receive a percentage of your PIA depending on when you apply. So if your full retirement age is 66 and you apply at 62, you'll receive 75% of your PIA. At 63, it'd be 80%, and so on. If your full retirement age is 67 and you apply at 62, you'll receive 70% of your PIA. And these amounts are actually prorated monthly, so you can apply anytime after the age of 62, and your benefit will be reduced by the appropriate amount. If you apply for Social Security after full retirement age, you'll earn delayed credits of 8% for each year you delay. So if your full retirement age is 66 and you apply at 67, your benefit will be 108% of your PIA. At 68, it'll be 116%, and so on. It's worth noting, though, after age 70, you can't earn any more delayed credits, so it doesn't pay to wait until after age 70 to apply for Social Security. Age 70 really should be the maximum age you apply for the benefits. So I'm guessing you're a lot like me, that you're probably not too interested in calculating by hand your AIME or your PIA and the reductions in credits for early or late filing, or the annual COLAs that could raise your benefit in the future, etc., etc. So you can find out approximately how much you can expect to receive in benefits in one of several ways. First, you can obviously reach out to us. We have a number of great calculators that actually do factor in all those different things, in addition to a lot more. Another option is you can refer to your annual Social Security statement. Those are always available online at the Social Security government website. You'll see a set up an account by answering a few questions. Another option is you can use a retirement estimator on your Social Security account. This calculator taps into your specific earnings history after you enter in your information. Please note, though, that the annual statement and the retirement estimator do not factor COLAs into your age 70 benefit. So what this means is your actual benefit will likely be higher than they indicate, but our calculators do actually adjust for COLAs and a number of other different factors that are pertinent as well. So if you know your PIA and you have it from your annual statement, we can help you project your future benefits. You also might want to try one of the 3 calculators on the Social Security website. Feel free to browse around the site and play with the calculators. If you're someone who enjoys that, at least it'll give you some information on what could be your possible benefit. So the decision of when to apply for benefits is one of the most important and most complicated questions. For married couples, there's no less than 18,000 different ways that a couple could apply for benefits, and it can literally make the difference of hundreds of thousands of dollars over your lifetime, and I'm not exaggerating that number. So before we get into number crunching, it's important to realize the decision of when to apply for Social Security depends on a lot of different factors that are very unique to each person's individual situation. And those things can include your health status, your life expectancy, your need for income, whether or not you plan to work, and if you are a surviving spouse or have one, whether you're going to have other personal resources. The when to apply question, like I mentioned, is very complex, and it really requires a customized analysis. But here are a few points to remember as just a high level. If you apply early, your benefit starts out at some fraction of your PIA, 75% or 80% or whatever, and remains at that percentage for the rest of your life. It does not go up to 100% when you reach full retirement age. It's also worth noting that you are generally only given 12 months after you register to receive benefits to reverse or change that decision. Once that 12-month period is up, it's irreversible. So take the time and do the due diligence in advance to make sure you're making the right decision. COLAs, magnify the impact of early or delayed retirement because the annual cost of living adjustment is applied to either the lower amount or the higher amount, and this causes this disparity to really increase exponentially with each passing year. The when to apply question impacts survivor benefits as well. High-earning spouses are typically encouraged to delay benefits to age 70, and the reason for that is because it will give their surviving spouses the highest benefit after they die. So let's look at some strategies for maximizing benefits. The first thing you can do while you still have time is improve your earnings record. First, check your annual statement to make sure your earnings record is accurate. Mistakes are generally rare because the earnings kept on file at Social Security were reported by employers when they submitted your Social Security taxes. But mistakes can happen, especially for self-employed people whose earnings records are actually taken from their tax returns. The next thing to consider, how you might be able to improve your earnings record. If you don't have at least 35 years of earnings, can you work a few more years so they won't be filled in with zeros? If you had several years of low earnings early in your career, can you work a few more years now while you're in probably your peak earning years? And that way it would really drop off the lower earning years and they would be replaced with higher earning ones. And even if you start receiving Social Security and continue to work, your earnings record will be updated. However, it's important to know that if you start receiving Social Security before reaching full retirement age, and if you earn over $21,240, $1 in benefits will be withheld for every $2 you earn over the threshold amount. So another strategy for maximizing Social Security is to apply for benefits at the optimal time. And we've been making a case for delaying benefits because that usually results in the highest lifetime benefit for you and your surviving spouse, but there is no one-size-fits-all answer to this question. The important thing is really to apply at the time that is optimal for you and your family. Another important consideration in deciding when you apply for benefits is whether or not you plan to work. If you apply before you turn full retirement age and earn more than $23,400 in 2025, $1 in benefits will be withheld for every $2 you earn over that dollar amount. I believe I might have misquoted that figure on a previous slide, but in 2025 at least it is $23,400. Now it's important to know that this money isn't truly taken away. Rather, your benefit will be adjusted upward when you turn full retirement age to make it as if you had applied later. And so what this means is that some of your benefits are withheld due to the earnings test. Your new benefit will be higher as if you had started at 63, 64, or 65 instead of 62, for example. But as a side note, please don't let the annual earnings test discourage you from working. The more money you earn, the more money you have to live on, obviously. Social Security doesn't penalize you for working per se. It really doesn't. Once the adjustment's made, you'll end up with a higher benefit for the rest of your life. And of course, the earnings themselves are going to contribute to your own financial well-being. The only surefire way to avoid the earnings test entirely is just wait until your full retirement age or later to apply for benefits. But again, if that's not what's best for you, then don't feel guilty if you have to apply for them early. The third strategy for maximizing benefits is to coordinate spousal benefits, and we've really been hammering this. The goal is to maximize income for both of you while you're alive and maximize income for the survivor after one of you dies, and it can be quite complicated, like I alluded to. But by understanding all the considerations and doing calculations, I mean, it's really possible for married couples to come up with the right solution for their needs. It's just going to take a little bit of work, or having a group of people who are knowledgeable of these things do it for you. And we obviously from the slide, this is something that maybe people don't always think about before they start drawing Social Security, but the benefits are going to be taxed, possibly. So here are some ways to possibly minimize those taxes. One way is you can lower your other income, especially investment income. You should be aware that municipal bond interest, while it is typically tax-free more often than not, and that is a very powerful tool to use in portfolios, which we use pretty regularly, it unfortunately does count as income for the purpose of calculating the tax on Social Security benefits. So another thing you need to be aware of, aside from just the fact that you're receiving this tax-free income, is that it is actually going to unfortunately impact how Social Security benefits are taxed. Another thing to be aware of is you have to anticipate the required minimum distributions that you're going to have to take one day from your IRAs, 401ks, 403bs, etc. because those could cause you to be in a higher tax bracket and may cause some of your Social Security benefits to become taxable. So one thing you can do, or a few things you can do, consider drawing from your IRAs earlier. Pardon me. Consider converting some of your traditional IRAs or traditional 401ks into Roth IRAs, which later will produce tax-free income. Now, when they are converted, it is considered a taxable event, but one of the cornerstones of our practice is we help clients to proactively figure out how to mitigate taxes. And when it comes to Roth conversions, there is typically what we call sweet spot, or an ideal window of time around retirement and drawing Social Security benefits when you can convert the maximum amount without negatively impacting your Social Security benefits and while keeping taxes to a minimum. If you're curious about that, reach out to us. We'll be happy to share information about that. Another way you can minimize taxes is delaying your benefits in order to reduce the number of years benefits are subject to tax. And then if people are able to, obviously you can reduce your expenses, pay down debt, adopt a simpler lifestyle. We're not going to tell people how to live their lives, but if it is all possible for you to do so, this could make things much easier. And then the last point, and I think this is absolutely critical, continue to manage taxes throughout your retirement and not just the first few years. We have found that especially when you're in the first few years, you're going through a major transition of drawing earned income or maybe passive income from either real estate or maybe a business or royalties, or if you're actively involved in a business, your income is usually providing for your lifestyle. You're usually transitioning from those things into drawing income from other sources, such as retirement accounts, investment accounts, joint accounts, trust accounts, a number of different sources. And so all those different things do create a number of tax transitions, especially the first few years, but that does morph and change quite a bit once you're more established in retirement and been retired for a number of years longer. So this is not a set it and forget it. You should always be consulting with your own tax advisor about your individual situation, but you should also be coordinating with your financial advisor, if you have one, or us, to help proactively plan for taxes and mitigate them wherever possible, and be aware that it is a moving target. It is going to change as you progress through retirement. Another strategy we look at for maximizing the benefits is to coordinate with your overall retirement income plan. And I'm kind of touching on that already, but it's really important to consider Social Security in the context of other retirement resources. And this could include pensions, IRAs, 401ks, 403bs. We mentioned the required minimum distributions you'll be needing to take by the time you turn age 73, but also your overall investment portfolio. Are you planning to work in retirement? Also, though, like I already mentioned a little bit, if you own a business or real estate that generates income, this presents a lot of opportunities, but also challenges as well. And the tax treatment of that income or those resources is very different than others. So we've actually built a framework just for people in these categories to streamline income, mitigate taxes, preserve and grow assets, and ultimately leave a legacy if that's what's important to you. The bottom line is all of these resources should be considered to give you the income you need for the rest of your life and make sure they are being handled and managed appropriately, but also efficiently. So don't be afraid to ask for help. Retirement planning tends to be much easier when it's a matter of just stashing part of your salary into a 401k or an IRA when you're starting out. But when the time comes for you to convert your nest egg that you spent the majority of your life building into an income stream, you really want to make sure it doesn't run out, that you're not paying excessive taxes or more taxes than you absolutely need to, that you're coordinating benefits, not only to get the most out of them, but also that you're not missing out on opportunities that maybe you weren't aware of. Social Security may be the bedrock of a person's retirement income plan, but it always must be coordinated with other resources to give each person stability and security that they all desire. So I know I covered a lot of ground and people probably have a lot of questions, such as, these that are on the screen. When should you apply for Social Security? What if you want to keep working? What if you've already applied? How much will your benefits be? How can you coordinate spousal benefits? We didn't even touch on benefits that you can receive if you've been divorced. And for those of you who aren't aware, I just worked with another client in this situation not that long ago. You can actually draw from your divorcee's benefits if you meet certain criteria, even if they've already passed away, even if they've been married multiple times. And believe it or not, even if you have multiple ex-spouses all drawing from the same person's Social Security, that doesn't necessarily mean that one's going to be impacted by the other. And that's just things that we hadn't even touched on today. Some of the other questions are, what's the best long-term strategy for your situation? What should you do next? We'd be happy to help you consider each of those questions individually and help you come up with a plan for your personal situation. And really, the reason for that is, like it says here on the screen, Social Security is far too important for guesswork. So I'm not going to just read off the screen, but really this is the point I want to make. Let us help you protect what you've built and maximize your income for retirement, while also mitigating taxes and figuring this out in the context of your entire wealth plan and strategy. So I know I covered an awful lot in a relatively short amount of time. I hope everyone got a lot of value out of this. If there are any specific questions you may have, feel free to email them to us at info@mat25capital.com. You can also visit our website at mat25.com. Again, Social Security is a complex issue with a lot of nuances, a lot of moving parts. We're happy to talk through these situations, show you how we add value, and if we're a mutually good fit, we'll be happy to help in any way that we can. So again, last time I'll say it, but if you have any questions, feel free to send them to info@mat25capital.com. Thank you for everyone for tuning in. Hope you enjoyed it and got a lot of valuable information out of this, and we hope you all have a blessed day.